Hello. Hello, hello. It was so bright. It's so gorgeous outside. It was so bright when I was here. I had to turn off the hello. Good morning.
How are you?
It's in the Northeast office. Yes, ma'am. Are you in the South office? Nobody there. No. You know what, dear? Why don't you just zoom in? I'll send you the Zoom link. That's fine. No, because we're on for 2 hours. So don't worry. You're fine. No stress. No stress at all. Take a deep breath. We're fine. You're safe, and I'm going to send the link. You're okay, dear. Yeah, you can do that. And then I can share with everybody. Perfect. Yeah, I'll send you the link. Okay. You're fine, dear. All right. Bye-bye. Hey, everybody. Good morning.
Good morning.
Can you hear me? Oh, good. You can hear me. No, I'm always technology challenged when I'm here in the Northeast office. We're going to give it just, oh, now I lost. What did I do? Signal. Okay, hang on. We're working this up. Something. There we go. Now I'm back. Whew. How is everybody this morning? Somebody tell me something good. It's beautiful out. I'll tell you something good. It's so bright and the sun is shining so much I had to close the blinds. Somebody else. Who else is going to tell me something good?
Really enjoyed the awards banquet last night. It was well done.
Yeah. Dana's one of the award winners, and it was such a good night. I was so proud. It was the South and West office had their awards banquet last night. We had a whole bunch of winners.
Yeah, we did.
Good food, and everybody looks so pretty. Everybody's all dressed up. People clean up nicely, don't they, Dan?
They do. They do. I put on my accountant outfit, and you know.
I love that I got to meet your wife. That was special for me.
It's special for me every day.
No, I can see why. Awesome. Anybody else? Somebody else. Tell me something good. What good happened this week? Something amazing, or something little that is almost amazing.
I got my first referrals from that op city, and they were actually decent.
Awesome. Awesome. Yes, Jen, we need to talk about leases for a little bit at some point in time.
Oh, I went through and read all that. I'm on board.
Oh, you're all ready. You're all good. Okay.
Yeah.
And your listing that you've got under contract, that's going smoothly.
Yeah, the inspection is Monday.
Okay. Very good.
Yeah, everything's going good.
I love it. You're on fire. Anybody else? Anybody else? Tim, were you able to get in? Did you not get the link? Wow. You know what? I bet I just sent it to the wrong email. That would probably make sense. I sent you send it to the email that was in here. Yep, it went to First Merchants. What is it?
Diersing. Diersing. At Centier.
All right, so we have two guests today. We have Tim, I spelled that wrong. We have Tim Diersing with, I can't talk and write at the same time. Hang on. We have Tim with Centier Bank, who is getting the link right now to jump on so that you guys can see him too on Zoom. All right, fingers crossed, it's coming to you now. And then we also have Sheryl Owens with US Bank coming. They both have different first-time home buyer programs as well as other programs as well that will piggyback off of what we did last week. Does everybody have the mortgage hacks playbook? Elizabeth, you may not have it. I may have to email this to you because you may not have this. I sent this out last week to everyone in coaching, and but everybody else should have this.
Yeah, I don't have that.
Okay, awesome. So last week we went through some mortgage products so that you can help get your partnerships with your lenders and know what products they own and be able to help your clients identify what products they might need so you can connect them with your right lender partner. So we're going to finish that up today with Tim and Sheryl. Sheryl went to the South office. She didn't know I was in the Northeast office today. So she is headed home and she's going to Zoom in with us. And then we also have, I'll be honest with you, when I listened to the second half of the mortgage hacks and I listened to Jason teach it, I decided that I could not do it justice. So what we're going to do this after we hear from Tim, and we may get started depending on when Sheryl comes on. But we are going to have Jason help us learn the mortgage hacks. And that mortgage hacks piece today is value that you can provide to your database right now to help them lower their payments. And also there's some really great information at the end on ways that you can help the client see how they can use some of those hacks to lower their interest rate. Tim, it still didn't come through.
Yeah.
How about I just show it to you and you just type it in? You got it. Okay. Awesome. All right. Hi. All right. We're getting there. We are getting there. Okay. Do you guys have the mortgage hacks playbook? This book. This from last week.
I'm going to hear much.
Okay. Well, you had it in your email.
Oh,
okay. Copy because I have a couple printed copies. Okay. All right. We're making progress. Tim's getting ready. Tim's going to jump in. Tim, I will tell you, we have an agent with us today who is in Louisville. Does Centier have any Kentucky? Okay. Well, if there's anything that you know that you could share, that would be great. And if not, Trey, we'll find you some first-time home buyers down there, lenders. All right. Here's the password if you need the Wi-Fi. It's remote. One, two, three, four, five. Okay. Oh, here we go. We are making headway. We are making headway. Some mornings is harder than others.
Yeah.
You missed the beginning part, Armand and Jennifer. We had our South and West Awards banquet last night. Okay. So and the only one besides me that's made it is Dan. So all the rest of our people. Oh, Shelby was here as well.
Really, everybody was talking about going to it this year.
Oh yeah, it was fun. All right, Tim, I'm tell you what I'm going to do. I'm going to mute myself so you don't get that back, and then you can introduce yourself. And I am going to make this so you can share your screen. And I'm going to make this so that you have the spotlight. So it's all you.
All right. I am here with a lot of feedback.
There we go.
So, as Carla said, I am, where's the camera? Oh, got it.
Can you guys hear Tim when he talks?
Yes,
Hello?
got him.
All right, good deal. Tim Diersing with Centier Bank. A little bit about Centier. We are a privately owned bank, so not publicly traded, based out of Maryville, Indiana, with a newer presence in the Indianapolis market. It's a small bank, a very small bank, $10 billion in assets, which is small by comparison. And we've got some unique processes as far as the way we go about lending, putting the customer and everybody involved first in the transaction, which is kind of refreshing. And it's working out really nice so far. So I'd really like to know the mortgage hacks that you're talking about. So if I can get a packet, I'd love to have that.
You can stay for that piece. You can listen to Jason teach those hacks. But this is what they learned last week. Last week we went over, where's the list of products right here? This is what we went over last week, except for home buyer assistance.
Gotcha. Okay, good deal. Well, I wanted to. Carla asked me to talk about our first-time buyer product. I'm trying to figure out, I don't use Zoom. I'm trying to figure out how to share my screen. How do I share my screen?
Bottom middle, you should see a green button where it says
share yeah,
screen.
big giant green button that says share screen.
What screen you want to share.
Got it. So we've got a loan product that is unique where it is a first-time buyer. It's targeted for first-time buyers. And it basically allows, if you can see my screen, and I'll email this to everybody in a nice PowerPoint presentation too later, but it's 100% financing. So, you know, you're buying a $200,000 house, you're going to get a $200,000 loan. So it's not down payment assistance. There's not any type of second mortgage or, you know, silent second or anything like that. It's just 100% loan to value. The great thing about that is PMI is not required. So 100% financing, no PMI. And it's a market rate. So based on a 30-year fixed rate with 3% down, that's kind of what the pricing is based off of, even though you don't have to have the 3% down. So I think yesterday it was 6.875 with no PMI, which is pretty strong.
Excuse me, Tim.
6.875 yesterday with no PMI.
Hey, Tim, we can only see your email.
What'd she say? I can't hear. I can't hear. All right, here, I'll turn mine up. I'm sorry, can you repeat that?
Oh, yeah, sorry. We're only seeing your email.
Yeah, that's all I have. That's all I have up right now.
Oh, okay. Okay.
So I have a more formal PowerPoint, which I don't really like them, but I can email them to you so you can review it afterwards. But this is just kind of a high level overview. You know, I'd rather have back and forth discussion than bore you with PowerPoint slides. But this is basically an introduction to the product. So 6.875, 30-year fixed, no PMI, fantastic. Minimum credit score is only 620, which is good. If you're at a 620 score, you might have some issues here and there. It just depends on why you're a 620 credit score. But my philosophy is to take a look at it, see what's going on, and get your customer pointed in the right direction. The good thing is what I do is I have a tool that we use at Centier called Credit Assure, where we'll look at the credit report, and with a couple clicks of the button, I can run some simulations for your customer on how to get them to 620. You know, if they're 612 or 600 or whatever it might be. And that has been very useful to me and to prospective buyers, you know, clearing a path for them to get to where they need to be from a score perspective.
No down payment, market rate, no PMI, 620 credit score, credit simulations.
You're keeping up so far.
Okay.
100% fine. Oh, I guess that would fall under no down payment, wouldn't it? So yeah, further down the line there, the debt to income max is 45%. So you know, that's pretty much the equivalent of a 50% DTI with FHA, since you don't have PMI on the loan. Occasionally we can make exceptions if we have a really strong borrower, but typically 45% gets the job done. Yeah. Okay. It's going to be a traditional income review. So if they're self-employed, we're going to look at tax returns.
Okay.
Yeah. Yeah.
Okay, do you take into consideration, you know, because in business we're trying to find as many write-offs as they can.
Sure.
Do you take those into consideration that, you know, is it based on their write-offs and that amount that they are showing?
It shows, you base it off of the net profit, but there's certain things that can be added back in.
Okay.
So like the most popular thing that can be added back in is depreciation on equipment. Like if someone owns a trucking company and bought a, you know, $50,000 piece of equipment, they write it off, we can add that back into income. So.
Yeah. So for example, just real quick, like I own a business, and so, you know, a lot of times, you know, getting close to tax season, we're going to try to find as many write-offs as we can.
Sure.
I don't know if you have it there. Are there lenders? You may
Yes.
have them as well. Bank statement holders.
Right.
The interest rate might be a little bit higher because the risk is higher for the lender. Remember, interest rate risks are, they go hand in hand. That's probably the biggest predominant reason for interest rate, right? So there are others, but they're probably not going to do a bank statement loan and no down payment.
Correct.
Because then your risk is through the roof. So you think about lending products and you think about risk. That's where that all goes into play.
I just have several business owners, and, you know, they're like, oh my gosh, how am I going to, you know, get approved for my first loan if I'm
you would look for a lender who has a bank statement product. They would need to understand that their interest rate may or may not, depending on their credit score, and what their bank statements show, may or may not have a higher interest rate. But they're probably not going to fall into no down payment loan.
Correct. And the bank statement loans are gaining popularity again with limitations. I'm not an expert on them because we don't offer the bank statement loan program. Okay. A lot of banks don't, unless you're in a unique situation, a relationship with the bank. But there are lenders out there that will do the bank statement loans. Probably a higher interest rate, probably a larger down payment needed, and probably higher credit score requirements. So they're looking for stability because, you know, lenders understand that self-employed individuals, it's not their true income, it's their tax liability, based on, how they've structured things. So, yeah.
Okay,
Yep.
thank you.
Yep. So we're basically, we will help self-employed borrowers. It's just we're going to average out the last 2 years' tax returns. Okay.
Thank you.
Otherwise, we're looking at standard income documentation, W-2s, pay stubs, things of that nature. While we're on the subject of income, so it's income restricted, meaning the total income used to qualify has to be under $72,000 a year. So not super high, but absolutely not super low either. Someone makes, so that is total income. Yeah. However, if there's 2 wage earners in the family and we don't need the spouse to qualify, we don't count the household income. We just count the qualifying income. So who's ever on the loan and whatever income we're using to qualify. For example, I have an individual right now that makes a $60,000 base, and they made, $20,000 in bonuses last year. So they're at $80,000. We're not using the bonus income to qualify them. So they qualify for the product. So you can make $80,000 a year, but if we're not using all that income to qualify you, and you're under that, 70,000, then you're good. Yeah, that's true too. That's true too. Yeah, exactly.
When you say that you don't have to qualify with the spouse, okay, does that mean that if the spouse is making $35,000 a year, that it just doesn't have to be included?
Correct.
It just also won't be included to figure out how much they can buy.
Right. So a lot of programs, a lot of down payment assistance and federal grant programs look at the household income, all of it, regardless of who's on the loan. Yeah.
I lost a couple because
Right.
they had too much income.
They were over the limit. So unique to this product, qualifying income only. So if we're not using overtime, we don't need to count it.
I really wanted her to take her boyfriend out, but
That's right.
Is there a minimum amount that they must make?
No.
Okay.
Nope.
Except for the loan, the debt.
Right. That's going to be factored in.
Gotcha.
Now, the good thing is in probably about 50% of Marion County, there are census tracts, which are subset zip codes. So little boundaries within zip codes are called census tracts. If you're in a low or moderate income tract where you're buying the home, there are no income limits. Low or moderate income tracts, there are no income limits. So
Kind of like the grant program you had before.
yeah, exactly.
The neighborhoods that are needing to be improved.
Right.
They are giving you a leg up.
Yeah, no income limits in those areas. And they're not, downtrodden areas either. I mean, some of them are, but, there's, I think virtually, near West Side, a lot of, there's areas in Greenwood that are low to moderate income tracts. There's one low to moderate income tract in Carmel, so that's something I can help you with. If we get into a situation where a customer's making $90,000 a year and they must purchase in a lower moderate income tract, I've got a Google map with shaded areas where you can search by address and see where those low to moderate income tracts are. And I'll share that with Carla via email too after this. And I'm sure she'll forward it out to everybody.
Yeah, absolutely. And that's where the partnership comes in, right? You got a lender that you don't have. This is great, right? So you can say to your clients, gosh, I have got a lender partner that's got an amazing no down payment loan program. Let me, get you connected with him so you can find out if you qualify. Like, you don't have to decide if they qualify. Tim will decide if they qualify. But you need to know enough to identify this could be a solution. And if, I'm just going to say this, and maybe Tim doesn't like this, but if you have they might still want to look at this product because they might be able to use that 20% for something else. Like maybe they could use that 20% to pay down to get their debt down. Like even when we talk about mortgage hacks, that's part of the mortgage hack, right? It is, even if they have a down payment, they still might want to look at the no down payment product, especially since it's at no market rate and no PMI. So let's say they only have 10% down and they're thinking about an FHA loan, right? They're going to have PMI on an FHA loan forever, like forever and ever, until they refinance. So this would be a better product. And they could use their 10% to make it pay down debt. So
yeah, and I see that all the time where, you know, I'd say, you know, 70% of the customers that I help don't have the money for a significant down payment, and that's why they're with me. However, there's a lot of individuals that have money set aside and they just want to explore options if they don't want to make a down payment. And, you know, typically what I'll do is I'll say you can do this, this, or this, or, you know, you've got, if you took that 10,000 you have saved and pay off the $4,000 car balance, you know, your purchase price increases. So it's just about making all the pieces to the puzzle fit and having a trustworthy loan officer to help guide the customer.
Okay. Sorry. No, don't be sorry. Okay, so I have a question about the debt ratio. Say, for example, a young person, you know, graduated college a few years ago, has a great paying job, doesn't have a lot of personal debt, but does have student loans. Mm-hmm. And those student loans are going to be astronomical because, you know, they're trying to pay for college, say, you know, but they've graduated, they've got a great paying job, but they don't have any other personal debt but student loans. How does that work? Because the college is so expensive.
Right.
And so
that's a great question. But on this particular loan product, on student loans, the federal government has something called the income-driven repayment program, where you're repaying on your student loans based on your income.
Okay. It can't exceed a certain percent of your income, right?
I don't know all the inner workings of it, but you know, someone making say $50,000 a year, and they're married with a small child, you know, and they have $80,000 in student loan debt, their income-driven repayment program might be $60 a month.
So it's not the amount they owe; it's the amount they have to pay. Like each month.
Correct.
So monthly payment. Debt is the
monthly payment. Monthly payment.
So
correct.
What all is included in your debt?
Anything that's reporting to the credit bureau is basically what we take into consideration. Okay. And then obviously the new mortgage loan.
But for like credit cards, it's just the minimum amount.
Minimum monthly payment. So you're looking at minimum monthly payment across the board on everything.
Okay. So it's that really, it's not the amount of debt, it's the payment on that debt. Excellent. Thank you.
And you know, I see a lot of that where customers $155,000 in student loan debt. They're like, I'm not going to qualify. It's like, well, it's not based on how much debt you're carrying for the debt to income ratio. It's based on what's your monthly payment. Right now, everybody has a 0 monthly payment because everything's in COVID deferral. However, you still can be on an income-driven repayment plan to show what your payment's going to be when that deferral ends. So they can't be on a 6-month forbearance, or they can't be on an in-school deferment, or they've got to be on this income-driven repayment plan.
Okay. All right.
So yeah.
And so during this time, you're looking at what that payment is, even though they don't have to pay it right now.
That is correct. So if they're not on an income-driven repayment plan, then we're using 0.5% of the balance of the student loans, which blows the debt to income ratio out of the water, basically. So you got $100,000 in student loans, that's $500 a month.
So they have to get on this plan.
Yes, yes.
Okay.
But it's simple to do.
Okay.
Any student loan servicer, you can do it online.
Okay.
If not, you can call the student loan servicer It's just educating the customer on, they don't know what they're on. Well, my payment's zero. Well, your payment's zero because you're on a 12-month forbearance or you're on a COVID deferral or whatever.
Time out. Database value, adding value to your database. What can you send out to your database from what you just learned about what they need to do if they have student loans? Is that an educational piece that a lot of people in your database make? And don't assume they don't have student loans. I mean, there are 40-year-olds who have student loans. There are probably older than that.
60-year-olds, right?
Yeah.
Right.
So don't assume. And if they don't have a student loan, do you think they might know someone who has a student loan that they could share that information with? So think about this. Now you make a list of things that I could put in a social media post, a Facebook Live, 36 touch campaign, and you guys come up with blanks. Well, we just inadvertently got one today. I mean, because you asked a great question. So thank you, Jennifer. Sure. I just have a lot of questions. Questions are good. Haven't you learned that from me? Yeah. You ask the most questions of anybody. Yeah.
Well, you definitely.
I learned something today. It's good for everyone. I didn't know that.
Yes.
Does she?
Yeah, I mean, I think the best thing to do if you have a customer interested and they have cold feet, let's just see what could happen, whether it's credit driven or income driven, or, typically it's a 30-second conversation with me or a couple emails back and forth to see if we have a shot.
Does this require a credit pull that impacts the
Yeah,
credit score?
yeah, it does. So anytime I pull credit, we won't do soft pulls. We can't do soft pulls because it's for the purpose of borrowing money. Everybody is hesitant to have their credit pulled, but you really can't get anything concrete without accessing the credit report. And it's a temporary ding to your score. But the good thing is, I don't know if everybody knows this or not, but in the last couple of years, you now have 30 days that if I access your credit for the purpose of a mortgage and Huntington Bank accesses your credit for the purpose of a mortgage, it only counts as one inquiry. So you're not getting your score dinged 10 times. So I believe it's 30 days, a 30-day time frame from the original mortgage credit inquiry. So if you come to Tim and Tim pulls credit and you don't like what Tim has to offer and they go somewhere else 3 days later, that doesn't hit them with another ding. So I run into that a lot. Well, I just have my credit pulled at, wherever, Fifth Third, and I don't want my credit pulled again. Well, I can't really tell you anything concrete until I look at your credit. This isn't going to count as another inquiry. So, yeah. No, correct.
They're not going to penalize a borrower for shopping.
Right.
Is what that is.
They're going to be asked about it eventually, like during underwriting, just saying, did you open any other credit based on this pool? Because obviously if it's 2 weeks ago, we don't know, it's not hitting the credit report yet. So no penalty.
Maybe you already said this. What is the amount of home that they can go up to?
Okay, so I didn't already get to that, but right now there's a $250,000 limit on this loan product. However, that's probably going to be increased in the near future.
Does that include in the income?
Yes. Yep. So that's probably the single biggest drawback to this loan product at this time is the 250. However, I do a lot of loans every month and, they're out there,
Well, that's, if you're working with first-time home buyers,
right.
That's reasonable.
Right. Absolutely.
It doesn't have to be a first-time home buyer.
No, it does not.
Have to be a first-time home buyer. And do condos.
We will do condos. The condo has to be approved by Centier.
Can I ask a question?
Sure.
On the 250 limit, is that based on the loan amount limit or the purchase amount limit?
Great question. So that is a loan amount, 250 loan amount. So if someone wants to buy a $275,000 house and they have 25,000 down, we can do it.
Great.
I was going to ask, on that income, how long does that income have to establish?
Good question. So on income, and this is another misnomer where people started their job 6 months ago and they think they need to be on the job for 2 years, and that's not the case. So as long as you have stable employment or consistent employment for a 2-year period, you're going to be okay. All right.
So if you were, oh, okay, that makes sense.
So yeah, let's just say, you know, someone worked at the CVS warehouse for a year and a half, and then they went to work at Amazon on Monday, and they come to me on Tuesday for a pre-approval. I can use that Amazon income. You know, we're just going to need 30 days of pay stubs, you know. Yeah, exactly. You just don't want them switching jobs in midstream, you know. Now, if it's bonus, commission income, that's a little different. You're going to take a 2-year average.
Because I guess I'm thinking owners about to graduate
Yeah.
college and everything. So as they move into their professional jobs, and
That is fine, because all you have to do, so there's exceptions to the 2-year rule. If you're returning to the workforce for whatever reason, recent divorce, if you were a stay-at-home parent for a period of time and you're going back to the workforce, full-time student, you know, so there's exceptions to that 2-year rule.
If they're moving here and they accepted a new job.
Correct. Yeah. So common sense. Everything's a little unique, but you know, we'll take a look at it. Take a look at everything. But yeah, not having 2 years on the job is not the kiss of death, which a lot of people think that it is. It just simply isn't. Another good thing about the product is we waive lender closing costs. So that's about a $900 savings. So no origination fee, no processing fee, which is kind of nice.
and all this is on your slides that you're going to
Yeah. No, you have to remember it all forever.
And you can read my handwriting, you'll be okay. And I've even color coded it. Look, negative, positive, see?
We'll give a $500 additional discount on closing costs with a Centier Bank ACH of the mortgage payment. So automatic payment from Centier Bank, get an additional $500 credit. It's kind of funny because guess what's required for this loan product? The ACH isn't required, but having a Centier checking account is. So why not just have an ACH from the Centier? Right. And, you know.
I'm assuming you could change your mind 6 months later.
Yeah, correct. You said it, I didn't. So this is going on YouTube sometime. So. Yeah, they need to open a Centier checking account.
And does it have to have like a direct deposit?
No. But you only get they have to have a Centier checking account. We want to establish a banking relationship with the individual, obviously.
It's a partnership. It's just like we talked about last week about partnerships. The bank wants to partner with them.
It is a big deal. You know? Yeah, it really is. But you know, what I've told people, you know, open the account, put a little bit of money in it, you know, transfer. You can do a bank-to-bank transfer so easily these days, from your Chase account to Centier every month. And then, you know, hopefully we'll win you over and you'll move your direct deposits over to us and we'll capture your banking relationship. So that's the premise behind it. It's give and take. So, I mean.
So when you say that, then how many locations is it?
Right now, I think there are 6 in the metro area, and most of them are north, Whitestown, 2 in Carmel, Zionsville. We're looking at an office in Johnson County. So yeah, we're not on every street corner, that's for sure. So if you have somebody that is traditional, you know, go into the bank every week, probably not the best option for them.
But just having a checking account that is your work. When we talk about some mortgage hacks here in a little bit, you can see the advantage of having a checking account that is just for your mortgage. Right. I can see that right now, how that would feed in. So there's a way around that. I would give up this loan program because I had to pay my mortgage payment through a checking account. Could it be a savings account or is that be a checking?
It's got to be a checking. It's got to be a checking. Yep.
Oh, do they have to keep balance? I mean,
well, there's different types of checking accounts. So there's free checking, absolutely free checking. And then there's options where you get some spiffs, but those comes with, you know, minimum balances of X, which I don't know what they are. I do know though, when you have a Centier checking account and you make 50 debit or credit transactions with your card a month, your connected savings account earns a 5% interest rate.
Woo.
Which is spectacular.
That is woo.
Yeah. Yeah, spectacular. Now 50 doesn't sound like to me, it doesn't sound like a ton because I think I swipe my card 50 times a month, but I think you've got to put some effort into making sure that you do it 50 times a month. So I heard one person went to the grocery store and rung up each individual item, you know, to get the 50 swipes in. Yeah, exactly. Exactly.
You could talk to in the grocery store like while you're springing up.
Right. Right.
I mean, there's gonna be all kinds of people mad at you. Just don't wear your color wigs. I don't know. You think gas 5 times a month?
My wife's probably already done that this morning. Yeah, exactly. Exactly.
Are you?
Yeah.
Yeah.
$10
Maybe we should do a Centier 5% hack. Right.
We'll do a class on that.
Okay. So the customer needs 500 of their own money into the transaction. That's typically covered by the earnest money deposit. Nope, no down payment.
So what's $500?
Well, it'll go towards closing costs.
Yeah, closing cost or you know, inspection or whatever. We just want to see them have some skin in the game. $500. Yeah. You know, you can use financing concessions from the seller if agreed to. That's starting to come back a little bit. You know, end of the day, with a $200,000 home and the Centier discounts, earnest money credit, you know, of $1,000, let's say, and property tax proration credit, the customer typically is going to maybe need $800, $900 at closing. You know, just depending on how things go. I've had customers, you know, walk away with a check at closing, not for, you know, $5,000, but, you know, they might get a couple $100 back or whatever. And I spell that all out for the customer up front with the pre-approval letter, you know, kind of showing the scenario. And then I break down here's the cost associated with it. And then here's all your credits or proposed credits. Here's what you can expect to have at closing, or you do at closing. When I met, okay.
So last week we learned about buy-downs.
Okay. Yep. Yep. Absolutely. I need to update my slide. So you can use a buy down on this if the seller has to pay for it. And typically on our 2-1 buy down, 2% rate reduction the first year, 1% rate reduction the second year. And it is about roughly 2.5% of the loan amount for the buy down. $200,000 house, you might be looking at $4,500 for the buy down.
It's 30-year.
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 No prepayment penalty. No recapture period, meaning you've got to stay in the house for a particular, that's a popular question with these products. How long do I have to stay in the house? Turn around and sell the house the next day if you wanted to.
But it does require owner occupancy.
Owner occupied only. Yep. Yep. So I think the most popular down payment assistance program is IHCDA, Indiana Housing Community Development Authority, but it comes with all kinds of strings attached, on an FHA loan or a conventional loan, where it's about a 9-year period before that money is fully forgiven.
So there's no second mortgage for the down payment or any of that?
No second mortgage for the down payment. The closing cost credits are credits on the settlement statement.
Yes.
Well, yeah, I mean, it's considered, I think, from a legal standpoint, a lender credit. Yeah. So that's nice. Yeah, exactly. So that's a big deal. It's relatively simple. Carla has worked with me in the past, and Tiffany has worked with me in the past, I believe. Oh, okay. Jay has. It's pretty simple. There's no inspections required. You should probably get an inspection, but we're not going to ask for it. We're not going to ask you to prove that you got one done. We don't pull tax transcripts. A lot of companies will pull tax transcripts, and it just opens Pandora's box. Or takes forever. Right. Right. Or you see someone got their tax refund offset by $76, meaning it was redirected. You have to write a dissertation on why that was, and is my $72 going to come out again somewhere else? I mean, there's good reasons for other lenders looking into that sort of thing, but most of the issues are minuscule, and they just create a lot of problems. So we don't pull tax transcripts unless you're self-employed. Another highlight, no rental history required. A lot of bank down payment assistance programs will require the customer to have some sort of rental history. Yes. Yep.
How about gifts allowed still?
Yeah, gifts are allowed. Yeah, absolutely.
All right, so I'm sure there's we covered all
the
major things.
Sure.
If they had a client that they thought might be a good fit for this, or I'm sure whether they would be a good fit for this, what would they do, Tim?
Call me, email me. If you give me it depends on your client's level of interest. If you're with them, call me, text me. Hey, I'm with a customer, they want to talk to you right now. If you're just trying to make an introduction or a connection between myself and the customer, best thing to do is email me with them on the email, and then I put them, I'll follow up with them as soon as possible, and I put them on a list to continue following up until we have a conversation and determine what the next steps are.
Are there any other loan programs at Centier that you think are really about?
Now this is it. No, I'm just kidding. There's a whole bunch. If a customer needs down payments and assistance and they don't fit into this, we've got the state of Indiana down payment assistance. We're really known for our one-time close construction loans. We have some really strong construction loan products. So if someone's building a home, custom home with a builder, we've got some unique products there.
How about land?
We do lot loans as well. So that's a big deal.
How about bridge loans?
Yeah, absolutely. Do bridge loans. So want to tap into the equity in your current home before you sell it, we can do that as well. Do all the run-of-the-mill products, VA, FHA, USDA, we do. All the little sub niche programs within Freddie Mac and Fannie Mae, conventional loan, 3% down, reduced PMI for customers that don't fit into the first time buyer bucket. We can assist. Those are the highlights though. Those are the highlights. Yes.
Typical closing time. Is it the regular?
Well, on my email here, I say 30 to 35 days, but I'll give you an example. I got a purchase contract on Monday. We have an underwriting approval as of yesterday, and the appraisal is supposed to be back this Monday. So right now we're moving pretty quick. That's one of the unique things of Centier is just about every mortgage department has laid people off over the past 6 months to a year. And Centier, family-owned bank, everybody's been told repeatedly, all of your jobs are safe. So they were probably fully staffed during the refinance boom. Obviously, turn times were slowed. But right now, the mortgage department is there and ready. And when the activity picks back up, they're still going to be ahead of the curve because they're not laying people off fully staffed. A lot of the mortgage ops people are helping in other departments too. But right now it is working like clockwork, which is really refreshing from my perspective. Good for everybody involved.
All right. Does anybody online have questions for Tim before we give Sheryl the floor? Or the screen? Sheryl. The floor and the screen. Tim, can you stop sharing? Awesome. Any questions for Tim? Let's see what's in the chat. What's in the chat says, we're seeing your email screen. Yeah, we got that. Shelby says yes. Yay, Shelby. Did you stay dancing late last night, Shelby?
All right, can you guys hear me?
Yes.
This trying to balance so that we don't have things. But Shelby, I just asked if you stayed late dancing.
Not too crazy late because Mason was like, I don't want to.
No, I can't hear. Hang on. I gotta put my sound back up. See this tech stuff. All right, Shelby, one more time.
Nothing too crazy late because
no, not too crazy late. I wondered how long everybody stayed.
All right. I want to say I tucked out at like 10:30.
Oh, okay. Well, not too much later after, or not too much behind me.
Yeah.
Okay, Sheryl, after your adventure this morning, the Zoom is yours. You're muted though. You're going to have to unmute.
There we go. Sorry about that, guys. I'm used to doing these meetings on Teams, and Zoom is kind of new to me. But yeah, I hope everybody had a good time last night. I had lunch with Christina Earhart yesterday, and she was looking forward to going last night. So
everybody looked so pretty.
I bet it was Hollywood, right?
It was Hollywood, yes.
Sweet. So I'm going to try to pull up my screen here to share with you guys. What am I sharing? That is not what I want to share. I want to share this one. Actually, let's go over to this one. Sorry about that.
I don't know, Shelby. Teresa might have given you a run for your money on coolest shoes.
Okay, that's fair. Second coolest shoes, at least.
Sorry, Sheryl. We were just going while you were finding your screen.
Yeah, let me find my screen and figure out how to do this. There we go. Is it coming up?
It is. There we go.
Awesome. Okay, so I wanted to do like kind of a comparison of all the different first-time homebuyer products that are out there. I did leave one off, and that was our first step, but I'll tell you.
You might make that a little bit bigger. Up where it says 100%, if you hit the plus sign, and that might make it a little bit bigger because we don't see. There you go. Ooh, that's good.
Is that good? Yeah, I've got my reader's EMP. Okay, so US Bank has several different programs, just like Tim was talking about, all the run-of-the-mill, the first-time homebuyers that are Freddie and Fannie, which would be the Home Possible and Home Ready products. Those require 3% down. FHA's 3.5% down, and USDA, VA are both 100% without any down payment assistance. But our biggest program for down payment assistance, which also includes closing costs in some cases, is our American Dream program. And it is underwritten as a conventional loan, but it does require an FHA appraisal. And the reason for that is they're going to call out any health or safety issues. And they do that because most customers that need down payment assistance or assistance with closing costs obviously don't have a lot of liquid assets. So if there's something that needs to be repaired that is a safe or healthy health issue, they're going to, make sure that that's taken care of before they buy the house. Now, we do have a rehab program, that's the American Dream, that will also include repairs in some cases. So that's something to think about. But our down payment assistance is 3%, like a conventional loan, up to $5,500 for your down payment and closing costs. So say you're buying a $100,000 house, $3,000 towards your closing cost, and the other $3,000 towards your down payment. The other $2,500 would be towards your closing cost. And that will go up to $10,000. So if you're buying a more expensive home and you need the 3% down payment, they will pay that. Gifts are allowed. So if you aren't getting seller concessions for the remaining closing cost, then obviously you're going to have to, either get a gift or come up with those closing costs yourself. Does that make sense?
It does. Now, is that $5,500? Is that a credit? Is that a second mortgage?
It's actually a second mortgage. It's a silent second. It doesn't accrue any interest. It does have to be paid back when you refinance or sell the home out of your proceeds. And the only time that it wouldn't have to be paid back is if you were not making any money off the house, sell of the house, you were just walking away free and clear. Or if your family income hasn't increased over the number of years, and they say increased by 5%, which most people aren't getting a 5% raise every year. So there's some different caveats to that, and I'll go through those in just a second here as well. Okay. The other thing about this first-time home or this down payment assistance is you don't have to be a first-time home buyer. So, there's people that are coming out of rent, whatever, or have sold a house, maybe didn't walk away with much money. Those people are going to be able to use this as well. So it's not required that you're a first or second time home buyer. Okay. Like there's some different products. Home Ready will allow you to be a second time home buyer. So that's something that most people aren't putting out there. There's no income limit on Home Ready, on FHA, VA, or USDA, but there is an income limit, and it's usually 100% of the area median income, which is it depends on how many people live in the household and what county you're in. So it can vary just from one county to another throughout the state. And then there are low census tracts. So communities that don't have a lot of movement that are trying to get people moving back into the area. I think someone was telling me that they had a place on the north side that just was kind of a desolate area that for whatever reason, nobody was going back into. Now it's getting rehabbed, and there's all kinds of people moving in there, and it's still a low census. So even people that are working on the north side or living where it's more expensive, can go in and actually buy without an income limit on those properties. So we also have the Indiana housing that Tim spoke about, and it is forgiven. It's a second silent mortgage as well, but it's forgiven after 3 years. So one of the nice things about that is we are actually the master servicer for all of the Indiana housing products, including one of the things that we have with the Next Home product is we offer the MCC credit. And I don't know if any of you are familiar, it's a mortgage credit that goes directly towards your taxes. So you can use it one of two ways. It's $100 to reserve it with Indiana housing, but over the lifetime of your loan, the lifetime that you're in the home or that you have a mortgage, you will get a tax credit every year, which can be used one of two ways. It can come off of your annual taxes, or it can be turned into your employer so that your customer is actually increasing their qualifying income because they're going to have a tax break, which is coming out of their pay directly. So for example, you pay the $100 and you get in and you have an extra $120. There's a formula that they calculate by. So that mortgage credit then would be applied to use as qualifying income. So if you're really tight on your debt ratio, that's one way to use that. $100 isn't anything really anymore, but it's something to at least consider when we need to maybe just get that extra scooch to get them into the house that they want and not the one that they actually qualified for at first. Anybody have any questions about that so far?
You're going to send this to me so I can share it with them?
Yes, I'm going to actually send everything that I've got that I had prepared for today. I left 10 folders at your Southside office, awesome. But I will send all these to you, and then you can share what you want with them.
Absolutely. Thank you.
Okay, you're welcome.
That means I'll share all of it with you.
Yeah, don't share everything. No.
Yeah.
Okay. Let's go to this one. Okay. Can you see it?
You might hit the plus a little bit up there.
Yeah, I'll make it a little bigger for.
I mean, we got you on the big screen, but it's a little, there you go. That's much better.
Okay, let's see. Yeah, because I need my readers as well. Let's talk about the first-time homebuyer and these programs, the caveats and reminders. A first-time homebuyer doesn't have to be actually a first-time homebuyer. Anyone who hasn't owned a home in the last 36 months is now considered to be a new homebuyer again, a first-time homebuyer. So you're still a first-time homebuyer, or you're still considered a first-time homebuyer, even if you've inherited a property from someone else or have obtained a property that you didn't actually go and do the financing for. Okay. The American Dream does not require a borrower to be first-time homebuyer. FHA does not require a homebuyer to be a first-time homebuyer. Home Ready does not. Home Ready, Home Possible, American Dream, USDA, and Indiana Housing require online homebuyer education classes. They're free, and I can provide the links to those if you run across those folks. The American Dream.
How long those normally are?
And some of them that they've had in the past require almost 4 hours online, but the framework that just came out from Freddie Mac is only about 45 minutes.
Okay, so between 45 minutes and 4 hours.
Yeah, it depends. And some of the different programs require you to take a certain class. So the American Dream does not. They've got 2 or 3 that we can use. So I always say, the 45-minute class, because if I'm doing my job and you guys are doing your job, they're going to be pretty well educated as well. I'm kind of a hand holder. They call me the mortgage mom. I do a lot of first-time home buyers and a lot of young people. So just getting face-to-face with people and making them comfortable and making sure they understand, because this is the biggest investment that they're going to be making. So the other thing is student loans, deferred student loans. So they show no payment on your credit report. Different programs require that we still count a payment. So actually be truthful about their debt ratio. On the American Dream, we require 2% of the balance be used as a payment towards their debt ratio. Home Ready, which is Home Possible, which is Freddie Mac's program, they only require that we count 0.5% of the balance. And Home Ready, which is Fannie Mae, require that we count a full 1% of the balance. So can really throw your debt ratio off if you're actually, not making payments, but they're going to come out of deferment. Used to be it was if they were going to be out of deferment within 3 years. Now it's just period. They have to count something. Yes, another thing about the American Dream, they do not allow for you to have more than 5% liquid assets after closing. So if you've got a customer and they've got 30,000 in the bank and they just don't want to spend their money right now, you might suggest that they withdraw it and put it somewhere else so that it's not sitting in their bank account when the underwriter looks at it and knows that we're going to have more than 5% left after closing. Okay. Let's see. Oh, gaps of employment. I think Tim spoke about not working or working for a full 2 years. So we've had people that maybe were laid off or during COVID had issues. So if there's a gap of employment that's less than 6 months, we're good. If the gap is over 6 months, we have to have the first paycheck for 2 months. Back to work for 2 months, and then a full 2-year history prior to the gap. And let's see, Home Ready, Home Possible, and USDA and American Dream are going to count the income of anyone over 18 living in the house. So when we talk about our income limits, they're going to look at that too. Most of the time, you're not going to put your kids on your mortgage anyway, so they're not going to really know if you've got an 18-year-old that works, you know what I mean? But spouses, they will know from your tax returns or your tax transcripts, which we do pull. Anybody have any other questions about that? Are we good? You're quiet this morning.
I can't think of anything. You're very thorough.
Okay.
I mean, and I'm the queen of questions. You'd think I could think of one.
I'm like, well, somebody's got to ask me something here. There is something I wanted to kind of go over with you guys, and I don't know if Tim did this or not, but give me just a second here. This new pricing adjustments.
No,
so
and I'm so glad you're doing it.
Yeah, it just came out on Monday, and this was initially only going to be Fannie Mae. They were the only ones making the announcement about this, but as normal, Freddie Mac followed suit. So what's happening? Basically, there are, I don't think I made, dang it, I wish I would have pulled up these price sheets because I had them in the folders. So when somebody goes to get a loan, and everyone's always been told 740 is your sweet spot, right? That's the best tier you can get. Well, they went through and decided that 740 wasn't good enough. So right now they've added 2 new buckets with adjustments. So the top tier score now is a 780. So basically what that means is 740 to 769 is going to get a hit to the rate. 769 to 779 is also going to get a hit to the rate. So when someone's like, I've got a 700 credit score, usually you're thinking, this is a big deal, but now they've made it even more aggressive. So not only did they add those 2 tiers to the pricing, but now they're adding debt ratio. So anybody that has a debt ratio over 40% is also going to get a hit to their rate. So I wanted to make this easier to understand. So let me just so let's say Mr. and Mrs. Mahomes decide they want to go purchase a house with a $270,000 purchase price, and they only want to put 5% down. They have a middle credit score of 750 and a debt ratio of 45 on a conventional 30-year fixed loan. The way it was before this past week, can you see this right here?
Yeah, you might make it just a little bit bigger with the plus sign.
Yep. Is that better?
There we go. No, I can't.
Okay. So on the 1st of February, a 6.5% interest rate would have cost 0.391%. As you can see, the rate's gone up a little bit. On the 6th, it went up to 0.554. The reason I'm showing you that is because when I can go all the way up to this and get a pricing exception. So I can give that to the customer without any cost, right? But here are where my hits are going to come in. First of all, you get negative, or you get 0.5% off because it's a purchase. That stayed the same. You get 0.5% off, or I'm sorry, 1/8% off for the loan amount being over 250. You add 25 for the FICO because it was still a 750. Now it's 50% for the FICO because the 2 new buckets that they've added, and because their debt ratio is over, it's 40%. So the cost of the rate would have been $40 on the 1st. The cost of the rate on Monday was $625.
Wow.
Yeah. So, I mean, it's a big deal. And I've ran into other loan officers that don't even know about it yet. And it actually went into effect on Monday, but they aren't going to hear about it until they go to deliver to Fannie Mae.
Did they say why? What caused this? I mean, is there all of a sudden a large amount of defaults, or?
There have been, well, basically because everyone was protected through COVID, there were no foreclosures being done.
Right.
So I actually got a call from another realtor the other day he's got a house listed. Okay. The lady bought the house in 2020. She moved in on a down payment assistance program. So she had $1,000 skin in the game total. She never made a payment. And they are just now able to foreclose on her. So she's been in her home 3 years and never made a payment. So that's part of the reason that they're doing this kind of stuff.
Okay.
So let's just show you the difference. I mean, this is another big one. Mr. and Mrs. Hertz want to buy a home and their sales price is 180 and they have 5% down. They have a middle score of 680, still not bad, right? And a debt ratio of 42 on a conventional 30-year fixed. On the 1st, they would have been at 6.75 with a cost. Oh, well, it's actually that 99 would have gone towards closing cost or buying the rate down. They also had 0.5% off for the purchase. And because the score being 680, they would have paid this much for the FICO, right? Now they would be paying 7.5 with a cost of 0.631. They would have gotten a credit for the purchase. They weren't over the 250 loan amount, so there was no other credit for that. They would be charged now the same 1.125 FICO, and because their debt ratio is 42%, they would be paying 0.375 for the debt ratio. So where it would have cost them $324 for that rate on the 1st, it's now $1,135.80.
Sheryl, Shelby is asking in the chat, what does cost of rate mean?
I'm sorry, say one more time.
What does the cost of the rate mean?
It means that either we would have, I sell my rates at par. Okay. So basically what that means is I have to go down the rate sheet, take all these adjustments, and I try to get as close to zero as possible. If it's not, then I have to actually either charge the borrower or raise the rate. So most people, I hear a lot of people talking about the 3-2-1 buy downs and so forth. I'm not really sure why they're doing that when they're going to go back to the original interest rate. If the seller is willing to give you $2,000 or $3,000 towards buying the rate down, buy it down permanently, right? For the life of the loan. So buying the rate, the cost of the rate is, what would happen is I would have to go either to a higher rate, which 7.5 was the highest on my rate sheet this week. So I would either have to get a pricing concession for part of it from my company and probably have to split this, but that would be an origination fee that the customer would have to pay or absorb.
Okay, that's what I thought, but I wasn't 100% sure. Thank you.
Yeah, I mean, that's exactly what it is. Typically, they would rather pay a little bit and keep the rate lower. But if they don't have the funds, then that's going to be either up to the seller or we have to raise the rate a little bit. Does that make sense to you guys? This is a really big deal because I've had so many people say, well, my neighbor just got a house and well, you don't know what their debt ratio is. You probably don't know what their credit score is. You don't know how much money they had in. There's so many variables that change. So when someone says, well, I just heard this bank is offering this, they're not really telling you the whole story. I mean, there's
their
always
starting point.
Right. That's exactly right. Also, they're not adding in when they're showing you monthly payments. They're not showing mortgage insurance. Does everyone know what private mortgage insurance is?
Yeah, I think everybody's got that. They have to know that to pass their test. If you don't know, it's okay. We'll talk about it later.
Right. Well, and another thing, the American Dream has no PMI. So even though it's a 100% program, there's no PMI on that program.
Okay. I love no PMI.
I love no PMI. Well, USDA doesn't have PMI and neither, but it's got a funding fee. So they pay that monthly through their monthly payment as well. And let's see, let's go back. I had a couple more things. One more thing. I don't know. I've had a lot of questions lately about bankruptcy. So I'm going to see if I can make this bigger. Oh, well, let's not do it that way.
Keep going. Keep
going. There we
go. There you go. One more time. There you go.
Yeah. Yep. There we go. Okay. So a lot of people don't know how long it takes before bankruptcy, or before you can buy a new house after bankruptcy. And it's really funny because on foreclosure, it's conventional is 7 years, 7 years on our portfolio products. The American Dream, if you've had a bankruptcy or a foreclosure, it's a 10-year wait. So it's huge. But then this is the conventional portfolio guidelines. And unfortunately, conventional is doing 10 years now on just regular bankruptcy, the Chapter 13. So FHA is usually 2 years. If you get an AUS approval, which is automated underwriting system through Fannie Mae, we can go ahead and do it. Rural development is the same thing. They usually ask for 3 years after foreclosure, but only 2 years after the dismissed bankruptcy. So if there was no foreclosure, you're good after 2 years. Otherwise, you have to wait 3 years. And it's not after the dismiss date, it's after the sheriff's sale date. So sheriff's sales can take a year. I've had some people that said they filed bankruptcy in like 2018, they should be good to go, but their house didn't sell until 2020. So they're still on that time crunch. Let's see.
What is bankruptcy without foreclosure?
I'm sorry.
Pam is asking, what is bankruptcy without foreclosure? You just filed bankruptcy, but you kept the house and you continued making payments.
Right. Or if you didn't own a home, there's
so
people
what is that? What does that look like? What was the time frame on that?
Without the without the foreclosure.
Bankruptcy without a foreclosure, yeah.
Right. That's going to be on a regular Chapter 13 back here. It's going to be for the conventional and portfolio, it's going to be 4 years right now. 10 for the American Dream, 2 for FHA, rural development, which is USDA or VA.
Let me ask you a question. If they have started foreclosure proceedings and you help them sell it and they get out from under it, does it count as a foreclosure or does it have to actually be adjudicated?
It depends on how their lender reports to the credit bureau.
Okay.
Because if sometimes they're showing that there's still a balance due, when they haven't, until it's sold, or if it sells for less than what they owed on it. So it will depend on how the lender reports to.
Oh, that's a good question. What does a short sale do to them?
Short sale, let's go to that. Here we go.
Oh, look, she had it.
I do have it. On a conventional, it's a minimum of 3 years from the completion date. On portfolio products, it's 5 years. Our portfolio products are all, we service all of our own loans, but we don't have to deliver them to Fannie or Freddie for a final approval. American Dream follows the conventional guidelines, which is going to be the same 3 years. FHA 3 years, rural development 3 years, and VA is only 2 years. So that's on the short sale. Chapter 7 and 11 are 4 years from dismissal date on conventional. This is 5 years on portfolio, which is, going to be the same as up here on the short sale. The American Dream is also going to be following the conventional 4 years. FHA is 2 years, and discharge 3 years for USDA, 2 years for VA. And there was one more here. So chapter 12, I'm not really familiar with the chapter 12. It's different for Fannie and Freddie. It looks like for Fannie, for Freddie Mac, it's only 2 years after the discharge and 4 years from the dismissal date, which is sometimes different, or 4 years for Fannie. Then again, 5 years for our portfolio. It'd be following the conventional guides for the American Dream, 2 years for FHA, 3 years for rural development, and only 2 years for VA. And then chapter 13 is the 2 years, 4 years from dismissal date, which I don't understand why usually the discharge date and the dismissal date are different, but they always go by the 2 years after discharge. So again, we're going to follow, the portfolio is going to follow the conventional. Conventional portfolio is going to be, 5 years. Sorry about that. 5 years instead of the 2 that is on the American Dream. 1 year of payouts under the bankruptcy. You can go ahead and buy a house if if you're following the payoffs and making payments and the trustee gives permission. And USDA is a full 3 years, and the VA follows the FHA guidelines. So when you start making your repayment, you can go ahead and buy a house. Multiple bankruptcies, they say 5 years.
Just crawl in a hole.
Yeah, just don't. That's all I'm gonna do. They're not even gonna look at multiple for the conventional programs. So
I can't even imagine what your credit score would be if you had multiple bankruptcy filings in the past 7 years.
You would be amazed. I do have someone that's got a 660 and has 2 bankruptcies.
Oh wow. Okay. Yeah. Well, never mind me assuming.
Just the one time I've ever seen that. So again, all streamlines, excuse me, all streamlined products like refinancing or something like that. We still have to go, most of them won't go through it at all, but we go 7 years to do it on an FHA. And that's about all
what I'm hearing here, Sheryl, is that if somebody says, if you ask the question, why would you like to, what is it that has you wanting to rent instead of buy? And they say, oh, well, I filed bankruptcy a few years ago. You say, what? We have a lot of exceptions to that. Let me get you with my lender partner who can walk you through. And even if you can't qualify right now, she's going to mom you until you're ready. Don't tell them that. She's going to take care of them until you're ready. She's going to mom you.
I might be guilty of that.
I love that you're guilty of that. That's great. We all have clients that need mommed, and we don't know what.
And that's, I don't understand. I've just met with a young couple. They actually have good credit. They were trying to decide whether they wanted to use a down payment assistance, or when they get their tax check back and then save a couple months, you know, come up with their 3 to 5% down. And I met with them at Starbucks one evening, and they were like taken so back that I would sit down and meet with them without them like having a purchase agreement in hand. You know, they couldn't get anyone to talk to them or explain things. So they printed out some stuff and had all this stuff highlighted. And so we went through our little thing. And then I said, I see you've got, you know, some questions. And they were like, never mind. You've answered. They didn't know, you know, what a settlement agent was. They didn't know. There were just things that they're hearing they don't understand, and nobody would talk to them. So, you know, the thing that I explained, they were talking about calling these realtors off the sign to go look at a house. And I'm like, no, do not do that. You get a realtor that's, you know, taking care of you, because that realtor already has, you know, an obligation to the seller to get the most money. You want your realtor, and you want your realtor to be your realtor for every house, because they already know what you like. They already know what you can afford. They're going to, you know, not just be sending you thousands of houses and saying, let me know which ones you pick. I mean, they're invested in you. So that's the goal. When we're working on someone's credit, I always mention the realtor. You know, hey, have you talked to Carla lately? Hey, you know, I'm going to let Carla know that you're probably a month or two out now, you know, and keeping them pulled in to the realtor as well. I mean, it's a relationship.
She's gonna partner with you. Last week, Sheryl, just, you know, one of the big things we talked about that's coming from Keller Williams International is that everybody has to have lender partners, people that do exactly what you're talking about. And Sheryl just told you why she would make a good partner, whether she realized it or not, because she's going to protect your interests while she's momming your clients. So,
yeah. Well, you know, I've been doing this for 23 years, and you find out that there's not a lot of loyalty out there sometimes, but when there is, and you have a partner, you know, I get people all the time. I have 3 kids that are between the ages of 35 and 29. So guess what they're all doing, and what all their friends are doing? They're out buying houses, right? They're our first time home buyers. So I have people that are coming to me and they're like, Mom, who do I use for this? Or I want to buy a house. Do I need an inspection? Do you know somebody? So I have plumbers, I have electricians. I mean, we have a team. I have a team of people that I work with on a regular basis, just because, you know, this isn't a group that's coming in, this age group anyway, isn't a group coming in that already have people established in their life. So yeah, I'll mom your kids to death.
I love that. All right. Anybody got questions for Sheryl? Thank you so much. I am so sorry about the mix up this morning, but I made it work.
It's my fault. I don't know why, but your office is completely unlocked, right?
It is, because there's other tenants in there, right? So they have business hours on Saturdays.
Yeah. Well, I was the only car in the parking lot, and I walked in and I went upstairs and I'm like, hello.
Well, we appreciate you. Thank you for coming on today.
Well, thank you for having me, guys. I'm going to
get all the information Sheryl's left. I'm going to get that all to you guys. If you'd like it in paper form, I've got 10 copies. She said at the office, if I run out, I'm sure if I ask her for more, she'll get them for us. And I'll also have it for you guys in email. And I'm going to put it in the library as well. So the PC library will have whatever Sheryl sends me. So.
Sweet. Okay, guys. Thanks for having me.
Thanks for coming.
All right. Bye-bye.
All right, guys. How you guys feeling about first-time home buyers now?
A lot better.
A lot better. I want to hear some action items. When we talk about our database, how could you identify people that need to know what you just learned today? You've got a great new product. I've got a great new product for anyone looking to home. I had training today and heard about an amazing loan product, or some amazing loan products that is going to apply for everybody. If you would like to hear about how you can buy a home with no down payment, give me a call, right? Then identify in your database anybody who's not a homeowner, right? Anyone who doesn't currently own a home needs to hear about these programs, right? If they're not quite ready, then Sheryl may be your best partner because she's going to mom them for you. If they're ready to go, this product from Centier is better than I have ever even seen anywhere else, right? So you spent the time here this morning. I want you to have an action item. Do something today with the information that you received. That's my challenge to you, right? Do something today with the information you received. All right. If it's all right with you guys, I'm going to switch over and let Jason walk you through the second part of the mortgage hacks. So this starts on page 21 in your mortgage hacked book. You need one? Okay. And you guys, I emailed it to you. Elizabeth, I emailed it to you this morning. Did you get it? Oh, you're muted if you're talking.
Yes. Yes, I got it.
Awesome. All right. All right. Here we go. All right. Hold your breath and hope I can make this work. That's making you have a lot of confidence in me, isn't it? Okay. Share. This may take a second so I can figure out how to get the sound to you. Share sound. I don't know what optimize for video clip means. It won't let me click it, so we won't worry about that. 21. All right. Share. Are you seeing Jason? Online, are you guys seeing Jason?
Yes.
Oh, yay. All right. I'm going to make Jason big because Jason deserves to be big. Okay.
So much. We covered so many of the products that are available.
Could you hear him when he was talking? Oh, yay. Yes. Look at that.
Today, now we're going to get into ways to hack mortgages for people that already have a loan. This is wildly important, again, because our 36 touches, which let's just stop. 36 touch doesn't mean 36. It's just a concept. It was an idea. Some people have the 72 touch. Some people have the 31 touch. Some people have the 57 touch. You do you, boo. I'm good no matter how many touches you want. What I'm not good with, though, I'm not good with touches that are not needed and useful. Meaning there are going to be some. One of them might be you and a lap dog. Picture of you with a lap dog. People love that. Or you holding a cell phone. Or don't tell me you don't have your prom picture that you're still using. I'm good with all of it. What I'm not good with, though, is adding in needful and useful touches as well. Needed and useful is the key. Helping people save money or make money, and helping people save time or have more time are the highest uses. That's it. We're going to help people make more money in the following section. Step number 4, understand mortgage hacks for homeowners. Build your value to clients by learning tools homeowners can use to save money over the short term or the long term on the mortgages that they already have. So what would you be doing with this content if you're a realtor? I'm so glad you asked. You could be standing up the seminar on mortgages right now. You should be, as an agent, teaching mortgage hacks. You should be teaching it online. You should be teaching it at live client events. You should be taking your best 5 agents out to dinner and helping them go through this together. You should be calling every single person in your data bank in a friendly TCPA way and going through and figuring out what's the best hack for them. You should be making social media clips and putting them out on mortgage hacks. You should be teaching at local colleges. You should be teaching this from the rooftops. Cool. So let's go into them. Okay, let's talk early payoff. There are several early payoff hacks that homeowners can take advantage of. By the way, the reason that hacking a mortgage and paying it off early makes sense is because interest is calculated by the day, which means the less days you have the mortgage, the less you're paying over time. So we gave you a bunch of different ones. Now you're going to say, oh, Jason, I already knew that first one. Nothing new here. Yeah, I get it. I was giving you the first one that I knew you already knew so that you could get comfortable with the format that we're using. And I'd like to explain to you what the curse of knowledge is. You see, the curse of knowledge dictates that because you know something, you assume that everybody else does also. That's the curse. Please don't assume that every consumer knows this. That would be stupid. Assume that everybody doesn't know it and that your job is to be the teacher. The first one we gave you, make one extra loan payment each year. By making one extra payment per year, a homeowner can reduce the amount of interest they will pay over the life of the loan and the duration of the loan. In this example, the monthly payment is $3,160. You know that because that's been the example throughout the entire book. By making one extra payment of $3,160, the mortgage will be paid off 6 years ahead of schedule with a net savings of over $156,000. Okay. Just stop. Because knowing it is one thing, but guaranteeing and making sure that everyone's doing it is something else. Friends, if you had a way that I could save $156,000 and you didn't tell me about it, I would be so mad at you when I found out. We got you. This is a thing. And what we showed you here was we gave you the exact chart, and you can see the savings, $156,023. That's a no-brainer if you can afford to make the payment. And by the way, everybody can. I spend about don't tell Gary, or Jay, or Mark King, or Jen David. Don't tell anybody this. I spend about $3 a day every day on coffee. Because the coffee at KWRI it's Drek. And so I stop and I get a cup. I want you to just know that would make up about half, and Sajik, don't tell Sajik, that would make up about half, by the way, of this payment if I was making it once a year. I'm just throwing that out there. You might have to stop your lattes in lieu of saving $156,000. Number 2, the pay bi-monthly instead of monthly. This knocked my socks off. By paying monthly, the borrower pays a total of $3,160 per month. With a bi-weekly payment, they will pay $1,580 every 2 weeks. That's all they're doing, taking the same payment. They're paying it every 2 weeks. By switching to bi-weekly payments, the borrower will pay $493,804 in interest and will shorten the repayment period to 24 years. Friends, that means they save $168,000. $168,000. I'm just saying. The next one's called the roundup. By increasing the monthly payment, you round up. Here's what we did. The payment we were making was $3,160. We rounded it up to $3,200. You get what roundup means now? We just rounded it up. That saved $32,000 over the life of the loan. That shaved 2 years plus off of the 30-year mortgage by simply rounding up. You know how people say it's a rounding error? It's literally a rounding error. That could save you $32,000. Number 4, $1 a month plan. Each month, increase the payment by $1. So good. By the way, if you do that right, that could reduce the mortgage by 8 years. I'm going to make a chart for you because it's going to be based on whatever your mortgage is. That's incredible. How about surprise money? We're going to show you what surprise money does in the next one. That's unexpected money that you get, send it to your mortgage. Gary Keller did that, by the way. Anytime he get extra money, he sent it to his mortgage. He paid off his house, I think, in 9 years. There is nothing wrong with it. Yeah, let's just address this thing. People say, there's all these gurus on YouTube these days. Some of the best are the ones that profess to be real estate people. I don't know the guy's name. He flies around in a jet. I don't know. And he says, owning your home is stupid. You should be a renter. First of all, that's asinine. And anyone that tells you that, you should run in the other direction as fast as you can because there's no data that supports that. That assumes that the money that you didn't spend on a down payment, you're suddenly going to get brilliant about and invest it in something. I don't believe that. People that own their home have more wealth than people that don't. Fact. Number 2, don't pay off your house. You always want to have a payment because of the interest rate deduction. Look, we could make as many charts as you want, but let's just get real for a minute. I've never heard anybody say, oh my God, I'm screwed. I own my home free and clear. Never heard that, as long as I lived. Matter of fact, I've never heard anyone say, this is the worst day of my life. I just paid my house off. Never heard that. I've also never heard, oh my gosh, I don't have a home payment. I'm so stressed about it. I've never heard that. I've never heard any of that, which means, you know what? You own your home free and clear, you're going to experience a different kind of freedom. You just will. The HELOC, That's the home equity line of credit, friends. The HELOC is as old as the day is long, but there's all sorts of uses for it. I'm going to tell you an interesting story about a real estate agent that wanted to buy income producing properties. Her goal was to create $15,000 a month in cash flow. That was her goal. What did she do? She went out and she got a HELOC on her house. She then started a postcard campaign where she said, I will buy your home for cash. Call me if you want an offer. She put her cell phone on it. When someone called her, she would make them an offer. She ended up buying the first 2 homes using her HELOC. She then refinanced those to buy the next 2 and the next 3 and the next 4. Friends, she then got up to 50 houses. She makes $15,000 a month passive. And it wouldn't have happened unless she would have started with her HELOC. By the way, if you love that, there is a class on it at MAPS that you can take because she has a group coaching program. Isn't that awesome, Joy? Yeah. You guys can't see Joy. She's off camera. She's smiling ear to ear right now. That's what you could use a HELOC for. Number 3, remove PMI. This is so crazy. So crazy. Y'all know what PMI is? Raise your hand if you know what it is. Yeah, of course you know what it is. If you put down less than 20% on a house when you bought it, the bank made you get principal mortgage insurance to protect them up to 20%. That was the gap. You pay it every month. But here's what's amazing. As soon as you have 20% equity in the house, the PMI, that gets to go away. But here's what's amazing. No one has ever gotten a phone call from a bank that said, hey, we realize that the value of your home has went up. And now, simply by living in it, you have 20% plus equity. We're going to lower your payment by removing the PMI. That's never happened in the history of Earth. You know why? Because the bank is more than happy to collect the money that you keep paying. Which means if you have any customers at all that had PMI on their house, because the value of the homes has went up so dramatically in the last 5 years, they may now have 20%, which means, here's the action item. Any single person that you sold a home to that had PMI, they should call their bank and say, yo, my value has went up. I think I'm now past 20%. I'd like you to remove the PMI. Friends, a lot of lenders will do that on the phone with them at that moment. They'll do what's called a desktop value review. They'll type in the address, the computer program comes back and says, yep, and then all of a sudden the payment goes down. That's a no-brainer. Get rid of an escrow account. Not all banks mandate escrow accounts. Remember, escrow accounts are those things that we fill, that the bank helps us fill. It takes into account our taxes on our properties and our insurance payments. And so instead of having those bills come annually, we pay a little bit every month, and then the bank remits payment twice a year or once a year to those vendors. But not all banks make you use that. As a matter of fact, if you have perfect payment history and you've been doing it for a period of time, most banks will say, okay, cool, no problem. We're going to remove that. Which means that you keep that money every month, which effectively will lower the payment. You can then use that money to go out and invest in something. You just have to make sure when those things are due, you pay for them. You could live in the investment property, aka house hacking. This is like purchasing a multi-unit property. The borrower can live in one side while renting the rest of it out. The renters pay the mortgage on the whole darn building. It's a great way to buy your first place, second place, or vacation place. You could refinance to a shorter term mortgage. If you're in a 30-year, think about dropping to a 15-year. That's instantly going to save you money over the life of the loan. Make payments with credit cards. Friends, most banks, they don't accept credit card payments, but some of them do. We found a few, some of them do, which means you could get the credit card points. This is a great way to save money. You can pay your mortgage and you can get points to go on wild vacations and travel like Mr. Voorhees does. That might be the way to go for you. Now, if your bank doesn't, what a lot of banks are starting to do is accept PayPal. PayPal does accept credit cards. So follow this. You could set up your mortgage to be paid by your PayPal account, which you would then pay with your credit card, thus getting you the credit card points and paying the mortgage. Hack! I could have kept going. I could have kept giving you more and more hacks. Here's now my question to you. In your touch campaigns, how many of you are teaching people how to pay less money over the life of their loan? Why not? Why not? Friends, this is the kind of information that people need. Meaning, if you are running a market center, this is the type of information that your agents need. If you're a real estate agent, this is the type of information that your consumers need. Friends, go out and do likewise.
All right. What do you think? You see why I couldn't do that? I got so fired up yesterday when I was walking on my treadmill listening to this so I could teach it to you guys. I thought I can't do this because I cannot do Jason Abrams. He's amazing, isn't he? All right. Action items. Yes, Armand.
That's
No, what were you gonna say?
I was just gonna say, yeah, you can, but you just have to spend more time trying to learn.
Oh no, I know it. It's not that I can't teach it. It's that I can't deliver it the way he delivers it. I can teach it. I can't deliver. Like, he's so funny. The facial expressions. I heard you.
I'm expressive like that, so I immediately was like, I like him.
All right, online, in the room, somebody tell me what you're going to do with what you just learned. I want an action item from everybody because you just spent 2 hours and an hour and 45 minutes learning a lot of things. What are you going to do? Okay, share the good news with your social media audience. You have lots of good news though. Look, if you take those mortgage hacks on page 21, and you take what you learned today, how many social media posts can you make out of that? How many touches, right? Because your database can't assume it all. They can't assume it all at once. You had a hard time. I mean, I've got more, but we're going to do more the next time because I don't want to overdo it, right? You've got 7 here. You've got 2, 3, 4, 5 from this morning at a minimum. Like that's 2 weeks worth of social media posts if you post it every day. But will they post themselves? Yep. So how do you make sure you get your social media posts about this? What do you have to do to get your social media post?
1 a day or 1 every 2 days?
1 a day, 1 every 2 days. But how do we make sure you do it? Where does it have to go?
Your calendar.
You got a calendar. Yes, you got a time block for this. So look at your calendar next week or do it tomorrow. You know, you can schedule in Command, you can schedule your whole week of posts, right? You just got to go in and spend the time to make them. But if you don't do something with this information, you wasted your time this morning. I mean, you got some knowledge, so it wasn't a complete waste, but let's turn this into business. How many of you guys need business? How many of you guys are happy with the paychecks you got in January? Is anybody happy with their paycheck in January? So we got to do something about it.
What's a HELOC?
A home equity line of credit. He explains that on page 26 in there. It's explained.
Hey, Carla, one of the things that I picked up and I absolutely love was just, talking about if they have equity in their home and making sure the PMI has been taken off or removed. So I'm going to use that as a touch point as I call through anybody that's purchased with me in the last couple of years, just, but then also my neighborhood, it's a new build. So how many people have, so much equity? So yeah, my mind is blown right now. I'm still trying to pull it all in, but this was phenomenal. Thank you so much for sharing this.
Oh, you're most welcome. But yes, absolutely. This is a perfect opportunity for you to offer your skills. You can do a free CMA analysis to see if you can save them money. And they're going to go, well, how's this competitive market analysis going to help me save money? Well, if you have PMI, we're going to be able to lower that, right? We can also take a look and see, is there any other hacks that I can do to, and when I sit down and walk you through your competitive market analysis, we can talk about some other things that I know that might help you save money, right? How many of you guys think that if you could help somebody in your database save $100,000 over the lifetime of their loan, they're going to be excited and they're going to remember you in real estate? That's going to solidify your relationship that way. All right. So, Jay, action item. What's your action item from today?
Well, like you said, it was a lot, but the main thing that caught my eye was the mortgage hacks. And I am going to call my mortgage company and see about getting that PMI removed off immediately.
I love that. Do your own, right? Take what you learned today and save yourself money. Thank you, Jay. Yeah. Yes.
Immediately. Absolutely. And I do like the HELOC information. I've been kind of studying HELOCs for the past couple of years, trying to make sure I got the right information. So I'm gonna put that with what I already know. And I really want to work on that. Use my own house to buy a couple buy a multifamily property actually.
Hey, I love that. Use the hack you learned for grow your investment portfolio. I love that. And Bond, you got an action item. Are you listening today? Or are you talking?
I am here for right now.
Yay. You got an action item from today?
Yes, I am going to come up with something about the mortgage payoff early hacks.
Okay. Love that.
Phenomenal.
And Ann and Jay, I'm so happy that Tim was here this morning. And I think that this product blows the last one that we were using for first-time home buyers out of the water, because it's not a grant program. It's just straight up. I love it.
Oh, absolutely.
Super excited. Super excited that he landed somewhere where he could bring his passion for first-time home buyers, or it doesn't even have to be a first-time home buyer, but super excited about that. I don't know, Shelby, I don't know if anybody else has ever worked with Tim, but my last year in production, half of my buyer transactions I did with Tim, and he was at another bank. You know, when you can tell somebody you don't have to have a down payment and you can still buy a home, it changes the world for people. I mean, you can make a difference in someone's life, because most people don't understand that. And the traditional down payment loan programs, like the ones that Sheryl talked about, they're great, but this is phenomenal. This evens the playing field, right? Yeah. This makes it, it's market rate, no PMI, 620 credit. I mean, like, amazing. All right, Tiffany, action item. I know you got one. Is that your only one? Because you're an overachiever. I'm assuming you have more.
I'm sorry, Carla. Oh, actually,
that was a compliment.
No, I know. I appreciate it. It just completely caught me off guard. Actually, I was just typing really quickly. This video, I think I missed it. Can I find this? Where can I find this? Because I need to watch this. I'm not supposed to share it, just so you know. So I'm gonna download it and put it on my YouTube channel. Okay. Same place where this video playing that will be there. That's what that's how I'm gonna get around it. Our video today is, I'm gonna send that out to all of you guys, and you'll have that. It'll be playing in it. Thank you. Then I won't get in trouble. I was like, I flagged my husband, like, come listen to this. So like, yeah. But no, I'm good for just the one for right now. No overachievement today. You're gonna do it. I know you will. Yes. You're going to take this to the next level, because you're a next level girl. All right, Elizabeth, I know this was a lot for you being brand new. Did you have any takeaways?
The whole thing is kind of new, and some of it I've known from, personal experience with my own home loans and stuff like that. But it's interesting just learning more about it. And it's stuff some of that stuff I had no idea. And some of it, like I said, I did some of it, but it's nice.
Well, you can find ways to save yourself money, and that's a great thing. And the other thing, if I were picking an action item for you, it would be go through all the people you know, and anybody who doesn't already own a home, call them and say, have you ever thought about buying your own home? And if they say no, then you want to say, what is it that keeps you from wanting to buy a home? And chances are they're going to tell you they don't think their credit's high enough. And if that's the case, and it's really not at least at 620, then you send them to Sheryl, and she'll mom them to get them where they need to be. Or if it's they don't have a down payment, but they have a good credit score, send them to Tim, and he'll help you get them in a house. So this is just a way to help you get business. So,
yeah, that's excellent information.
Awesome. All right, Shelby Keller, you got an action item?
I'm actually meeting with a first-time home buyer today. So now I'm like, I need to just take all of these little tidbits with me. My other action item is going to be an Instagram series.
Ooh, I love that. Hacks. Ooh, I love that. Very good. All right, Takesha, how about you? There you are.
Yeah, driving.
You're driving. All right. Well, do you have an action item while you're driving?
Yeah. I need to get my planner and put down that schedule, like you said. And I like that. I like Shelby's thing of an Instagram mini series, because I need to get my Instagram channel up. I mean,
okay. Well, we can't hear you very good. You drive.
I do have an Instagram.
Social media posts. Social media posts and making calls. I love it. All right, Pam.
Same thing, social media, making calls, and I really like
The healing for yourself. I love it. All right, dear. How about you?
So I'm hoping the weather is warming up today because I'm going to be doing some door knocking.
Ooh.
Introduce my neighbors that I am and I'm going to take these cards so they can fill out, and they're going to fill out the cards because they want to get in my database so that I can send them a newsletter.
So on your cards, what I would say is, would you like information? Yeah, I love that. But you could ask on the card, would you like information on how to save money on your current mortgage?
Okay.
That way they're going to be thinking and waiting for you. Yeah. Well, just a thought. That's a thought. Or just ask the question, right? Because one of the things I'm going to cover is how you can save money on your current mortgage. Even if you're not looking to buy or sell, I can still be of help to you. You can just say it to them if you don't want to update your cards.
Yeah, I'm going to say it.
I love it.
I'm going to talk.
Talk to them.
Home, I'm going to put the card in the.
Yes, I love it. Then use Mojo and you can get their phone number and you can either text them or email them as well.
And then my daughter, she postponed buying a house because she was getting a credit right and down payment situation. So I'm going to help her with it.
Oh, very good. Okay, very, very good. All right, Armand, action item. Social media posts. I love it.
social media, but I'm also thinking about how, say on the spot, being something that talks about mortgage hacks.
Yeah. You could just say, ask me how to save money on your current mortgage.
Yeah.
Yeah, I love that.
Yeah, like I've got like these acrylic, right now I have an acrylic sign up that says I love referrals for real estate, you know, which, and
just put it on the mirror. They all look in the mirror.
Yeah, exactly.
Yeah.
So yeah.
Love it. All right. All right. So we did not get to command or BLC today, but I hope you appreciated what we had and you're not upset with me because I think we had a lot of content today. So Monday, I'm on for open office hours. If you're having any BLC issues or you're having any command issues, you need help making your social media posts and command, come on for open office hours Monday and I will help. Our February, or that's the end of our February workshops. Our next workshop, because we have family reunion and then I've got a wedding. Our next workshop is on the 4th of March. And it is in the South office. And I'm going to have a title company tell you we're all partnerships right now, how to choose and partner with a title company and how to read a closing statement and how to explain the closing statement to your client. So that's what's on for the 4th. And then for the 18th, Jessica Harris, who's in the an agent in the Northeast office who used to work for a home builder, and some of the Northeast agents might know her because she's been doing builder tours. She's going to come talk to you about how to work new builds, how to protect yourself, how to work, how to best represent your client's interests, and how to create partnerships with home builders. So we got a theme going here, don't we? Partnerships. So that's March workshops. Okay. Anything I can help anybody with today?
Thank you. It's been great today.
Awesome. All right. Well, I'm glad because I want you to have value for your hours that you spend with me on a Saturday morning. Thank you for coming, and just text me this weekend if you need anything. I'm around. Happy Super Bowl.
You said the hacks are on this is recorded, right?
It is recorded. I will get it up. It'll be tomorrow. I'll probably email it out to you tomorrow.
Okay.
Awesome.
Thanks, Carla. Bye.
Bye, guys.